Welcome to the debate. The financial security of, well, millions of Americans really hinges on the solvency of Social Security. And frankly, the data is screaming at us. The 2025 Social Security Trustees Report paints a, let's be honest, a dire picture. The Old Age and Survivors Insurance, the OASI Trust Fund, it's projected to become insolvent in 2033. I mean, that's only 8 years away. If Congress fails to act and history suggests that's a real risk, every single retiree, current and future, faces an automatic 23% across-the-board benefit cut. It's a cliff edge.
I agree. The structural risk is immense. There's no question. I mean, a $26 trillion actuarial deficit for Social Security over the next 75 years, that's a stark measure of the imbalance we're facing.
Exactly. And this systemic risk, it demands an urgent, I'd say a mandatory, proactive strategy from individuals who actually have the means to execute it. So the core question, really the debate today is this. Should those who can, especially high earners, should they aggressively delay claiming benefits until age 70? Really max out that guaranteed lifetime income stream against this looming disaster? Or does that single-minded focus maybe overlook critical actuarial fairness issues and the harsh demographic realities that most Americans face? Look, I hold the proactive position. For those who can, delaying to 70 isn't just smart, it's non-negotiable insurance against systemic failure.
Well, I come at this from a rather different perspective. While maximization, sure, it sounds compelling in theory, the solution just cannot be a blanket mandate to delay claiming. My position is skeptical of this aggressive push because fundamentally, it overlooks the financial inability of the majority of Americans to actually bridge that income gap. And maybe more importantly, it ignores the very real differences in how long people live, differential mortality rates.
Okay, let's start with the sheer magnitude of the opportunity here and the absolute necessity of mitigating this risk. Insolvency in 2033 means potentially losing almost a quarter of your foundational income. The primary defense, the only guaranteed defense an individual has, is maximizing that income stream. So for a retiree eligible for the maximum benefit today, delaying from full retirement age, your FRA, to age 70, that boosts the monthly payout from what? Roughly $4,018 to $5,108. That's a 27% increase. And crucially, it's inflation adjusted for life. That difference, over $1,000 a month, that's your personal hedge against legislative disaster. And it also leverages future CLAs, cost of living adjustments, which compound year after year. You get bigger raises on a bigger base.
The typical retiree. You're really glossing over a critical problem here. The majority of beneficiaries simply cannot delay, or maybe it's just not actuarially favorable for them. The historical data shows this clearly. Look at 2010 figures, for example. Over half, 57.8% of men, 63% of women, claimed between ages 62 and 64. They accepted a permanent benefit reduction, sometimes up to 30% for someone whose FRA is 67. Now, why do they do that? It's driven by immediate liquidity needs, often job loss or health issues, and the hard fact is that early claimers generally have significantly lower non-Social Security wealth. We absolutely have to prioritize the real-world financial constraints of the average American over some hypothetical ideal that's really only available to the financially secure.
Okay, I see why you emphasize liquidity needs. I do. But let me offer a different perspective, especially thinking about the program's original function versus its demographic reality today. We need to tackle this actuarial fairness question head-on.
I agree completely. Let's look at what the data actually shows regarding fairness, because this is precisely where the mandate to delay breaks down for me. The whole idea that delaying claiming is actuarially fair, it relies on average mortality data. But the reality, the uncomfortable truth, is that this strategy actually exacerbates profound inequality. Why? Because life expectancy gains are heavily skewed toward higher earners.
That's a powerful point about differential mortality, definitely a challenge. Though I might frame its implication differently. The growing longevity gap is precisely why those who can delay, those who are likely to live longer, must do so aggressively.
Well, just look at the numbers. For men born in 1960, the life expectancy gap, measured at age 50, between the lowest and highest income quintiles, It widened to an astonishing 12.7 years. That's more than double the gap for the 1930 cohort, which was about 5.1 years. So higher earners are living dramatically longer and collecting benefits for a much, much greater period. This disparity means the lifetime benefit difference in dollars between the top and bottom quintiles shot up from around $103,000 for the 1930 cohort to $173,000 for those 1960 male cohorts.
Those figures are, they're troubling, and they absolutely highlight a structural flaw, perhaps, in the program's design regarding equity as demographic shift.
Exactly. So asking a low-earning worker, someone already dealing with liquidity issues and facing a statistically shorter lifespan, asking them to delay claiming, it effectively forces them to subsidize the longer lives of the rich. It fundamentally diminishes the program's core progressivity. It's simply an unfair optimization schedule for a huge segment of the population.
I agree the data shows the system is becoming less progressive over time, that's clear. But that challenge, to me, demands maximizing protection where it's possible, not abandoning the most robust tool we have, the DRCs. For the high earner, remember? That guaranteed check is essential insurance against market risks. Specifically, sequence of return risk. The danger that poor market performance early in retirement just decimates a portfolio irrevocably. Social Security already replaces such a small percentage of a high earner's pre-retirement income, maybe only 15% of a, say, $400,000 salary, versus maybe 35% for someone earning less. Maximizing that primary insurance amount, the PIA, via the delayed retirement credits, those DRCs, it provides a crucial inflation-adjusted anchor for their entire retirement portfolio.
You seem to focus on the high earner as if their only problem is complacency, or maybe they're just making what you call mistake 3, anchoring their claiming date to the retirement date.
I would argue that for many, it is complacency. It's sleepwalking into disaster by leaving literally hundreds of thousands of dollars in guaranteed income on the table. This is precisely the kind of unforced error the ultra-wealthy avoid.
But hold on, let's look at the actual complexity of implementing this maximization goal for that high-earning segment. It's not just a simple matter of saying, okay, I'll wait until 70. It involves really complex tax integration for starters.
Right, and this whole conversation about the strategic necessity of delaying to 70 for high earners, it really highlights this pervasive failure I see constantly in implementation strategy. You have retirees with significant accounts, 7-figure savings, making well above the earnings cap. They understand that they probably need the maximized benefit, but honestly, they often have absolutely no clue how to actually implement the sophisticated planning required. How do you bridge the income gap effectively between, say, retiring at 65 and claiming at 70? How do you integrate tax strategies like Roth conversions? It's often a complete mystery.
I agree that the mechanics are complex. For high earners who've already hit the earnings cap for years, their decision isn't about increasing their PIA through more work. It's purely about maximizing that payout factor, the DRC. But delaying requires sophisticated planning, like you said, to handle the tax implications. Remember, up to 85% of their Social Security benefits can become taxable income. Furthermore, it requires really complex integration with required minimum distributions, RMDs, once they hit age 73. So a high earner managing a large taxable portfolio and large RMDs might find their Social Security claiming strategy highly constrained by their desire to manage their overall tax burden.
And this strategic implementation, this is exactly where the sophisticated retiree must focus their attention, especially now given the current economic climate. Look, if the Social Security Trust Fund is potentially running dry in less than a decade, and inflation continues to be a persistent threat, just having a 7-figure paper portfolio might be dangerously insufficient. This looming crisis, it demands diversification beyond just traditional stocks and bonds. We see central banks around the world accumulating gold at 50-year highs. We see major institutional wealth managers increasingly recommending an allocation to hard assets, often suggesting 10%, maybe even 20% for some clients, as a critical hedge. A hedge against what? Against systemic insolvency, against currency devaluation. High earners absolutely must maximize their Social Security benefit and simultaneously aggressively protect the capital they're using to bridge that gap until age 70.
I do acknowledge the trend. The institutional consensus is certainly shifting. You're right about that. particularly for high net worth retirees. And many are using vehicles like gold IRAs to diversify their existing retirement accounts, adding that physical asset component.
Exactly. This shift is critical. And, this whole conversation really highlights something I see constantly. Most people with, say, $100,000 or more sitting in their IRAs or 401ks, they know intellectually they should probably be considering these institutional trends. They see what central banks are doing, but they keep putting it off. Why? Because they don't understand the mechanics. It seems complicated, maybe risky. This is precisely why we put together a comprehensive free gold IRA guide. It's linked right there in the description below. It takes all the mystery out of the process. There's zero sales pressure. It's purely educational. It details the common mistakes people make, the ones high earners need to avoid, and it lays out the simple 3 steps needed to actually get started with a rollover, which honestly, once you understand it, can take maybe 15 minutes. So if you've got at least $100K sitting in a retirement account, an IRA, 401k, 403b, whatever. This guide shows you exactly how the wealthy are positioning themselves right now to secure their future against inflation and currency risk. The very risks amplified by Social Security's instability we've been debating.
Okay, that process certainly needs clarity for those considering it, but let's bring it back to the Social Security calculation itself for a moment. The goal for high earners often isn't just about getting a bigger personal check. Crucially, it's about creating a larger survivor benefit for their spouse. And this is especially vital given the demographic reality that high-earning men often predecease their wives. I think the statistic is something like nearly 54% of women aged 75 and older were widowed back in 2021. So delaying claiming to 70 maximizes this survivor benefit. And that is often the key long-term planning objective, not just some abstract maximization game for the primary retiree.
But the fact that maximizing benefits at 70 achieves both the largest possible personal inflation-protected annuity and the maximum possible survivor benefit, that only amplifies the strategic argument for delay. It strengthens my point. Whether the primary motivation is pure self-interest or spousal protection or insulating the portfolio, that 27% benefit boost you get by waiting is the ultimate mechanism for securing long-term security against both market risk and, critically, legislative risk. If you have the assets to bridge the gap, failing to delay claiming benefits until 70 is simply, well, it borders on financial malpractice in this environment.
Look, we absolutely agree that Social Security faces urgent structural risks that demand personal action and, yes, proactive planning. However, we just cannot mandate a single strategy for everyone. The optimal claiming decision remains highly individualized. While maximizing benefits is undeniably crucial for those with the financial bridge to do so, that strategy absolutely must be balanced against the harsh realities of the growing longevity gap and the existing financial inequality in this country. The actuarial adjustment schedule, while mathematically sound on average, is simply not perfectly fair for every demographic, especially lower earners who face real liquidity constraints and statistically shorter lifespans.
Well, intellectual disagreement certainly sharpens understanding, but I maintain the evidence demands a proactive, almost aggressive stance for those who can take it. With Social Security barreling towards a potential mandatory 23% cut in just 8 short years, focusing solely on the average beneficiary's historical preference for early claiming seems incredibly risky, almost naive. For those with sufficient resources, financial capital, the strategic necessity of delaying to age 70, leveraging that 27% benefit boost, securing the protection of that inflation-adjusted income stream, it is the single most powerful insurance policy available against systemic insolvency. And this, combined with prudent diversification into hard assets to protect the bridging capital, that's the standard that all who can possibly afford it should be striving for. It's how the wealthy secure their future.
And we leave the listener to weigh the actuarial ideal of maximization against the demographic and financial realities facing individuals today. There is certainly, as always, more to explore in the source material we analyzed for this discussion. Thank you for joining us on The Debate.